Hey YouTube, so today we're going to be talking about living off of dividends and kind of how my portfolio is doing and kind of showing you the importance of investing now and not needing, millions of dollars invested in a portfolio to be able to live off of dividends. I'll show you kind of some of the numbers here and how it kind of works. So we're going to kind of jump over here into my portfolio. This is where I house my dividend investing. I do also retirement stuff, but strictly this is kind of where I'm focusing on dividends, although some people will kind of mention in the comments that some of the stocks I have here actually don't pay out dividends and they're really just growth stocks. But I'll show you why that's not really important for me today, because I'm going to be here long term trying to get this money earning me something really good in the near future, probably in about like 15 to 20 or so years, give or take. And what I'm personally using right now is a service called M1 Finance. If you guys end up liking them, I'll have a link for them in the show notes down below. You can click on that. Supports the channel, but it also lets you download and get a nice little $30 bonus for opening up your account. Now you can see with my account right here, my current value is $33,838. We've obviously been going through some ups and downs in the market at times, so I'm not really worried with how things are doing in the short term. If anything, during the short term and things are looking red, I tend to buy more. So if we go to the day, I think the day we ended up pretty well, over $400 in gains. And you can see here in the week, we're actually at 490, so it's kind of been a little teeter-totter the last couple days. But if you look at the last month, we're actually down $900. Now, to some people, that might be scary. That might be like a lot of money and saying, hey, that's freaky. But for me, I see that down, that red, and I end up buying more in the stock market as much as I can possibly. Now, if we go to the quarter, we're still up on the quarter about almost $800. And then if we go to the last year, we're up about $4,775, which is why it's so important to invest regardless of how the market's doing. It's better to be in the market than trying to time the market. Now, if we go to our all-time, we're up about $5,061. And for anybody that is just kind of new to investing, I just want to show you that I started this account in January of 2019 with $100. So if you are somebody who's like, whoa, 33,000 is a lot, that's not what I put in day one. That is something that I accumulated over time. Obviously, my money has earned money over time. Some of this is including dividends, which is about almost $375 in just dividends that I've earned. But none of that would have happened if I didn't put in that first $100. So open up an account, invest, and just start putting your money in. If you don't know what you're doing, that's totally okay. Hopefully these videos help you out, but as you move along, you'll get better. You might make some mistakes with $100, $200, $300, but as you start building up, to $33,000, hopefully most of those mistakes will have, gone past, and you're not gonna make mistakes with thousands and thousands of dollars. That's at least how I personally like to see it. Because I think for most of us, we get really fearful of, investing that much money. And I would be as well personally, but as I started, you can see here in the first couple of months, I barely was hitting, a couple $100, and then I finally got over $1,000 right before the year marker. So it took me over a year to get to the first 1,000, but then after that, it just started growing. I felt more comfortable and confident in what I was investing in and how I was going. Now, I do have videos on the channel here talking about like what I'm actually invested in. You can check those videos out. So if you want to see each one individually, but overall, I got different sectors, so I'm pretty well diversified. I got about 23 different stocks in this portfolio. It is obviously a little riskier going with individual stocks versus something like an ETF, which is a group of funds together. But effectively, I'm making my own. So you can see right over here, 23 stocks. So right over here, one of the big things when it comes to investing in any kind of stock is, am I going to earn dividends from it, or do I just want growth from it, or do I want a little bit of both? Now, for me, I started off with this portfolio where I was investing in companies that were paying pretty high dividends, about 4%. You'll see a lot of people talk about the 4%. I'll just kind of write 4% right there. So for a lot of people, 4% is kind of like the golden ticket or like the golden rule for, how much of a yield you want to be getting on your stocks. So for some companies, 4% is pretty achievable. For a lot of those companies, it's usually companies that have been around for a very long time, maybe don't have a lot of growth left in them, so they are paying out these dividends instead of focusing on the growth. So for me personally, that's kind of what I was focusing in on at first. But over time, I slowly kind of went away from the 4% and started getting stocks that were paying out like 2% or paying out even like 1% or even lower. I have companies like Apple. Right now, their dividend yield, what is their dividend yield? Their dividend yield right now is give or take about 0.71%. So not even a full percent of a yield is what they're paying on their dividend. Now, to a lot of dividend investors, that's a no-go, right? Like, you don't want to be invested in a company that's paying 0.71. That's really, really low. You can't live off of that. But here's the thing, right? So depending on your age, you might be needing dividend money now, which then yes, there's those 4% companies that you might want to be investing in and put your money in. But if you're like most people who are maybe 20, 25 years, maybe even 30 years before they need this money or even want to use this money, for me, it's about 15 years. So about like mid 40s is where I'm kind of expecting to want to use some of this dividend money in this dividend account that we have here. And so what we're actually focused on is dividend growth. A lot of people don't talk about dividend growth, and that to me is more important than the dividend yield that we get today. So if we go to Apple right over here, I'm going to actually show you, they did recent news that they've increased their dividend yield. Now, this is a pretty big deal for a lot of dividend investors, is the dividend increases, because the way that works is if a company increases the dividend and you already own shares of that company, you effectively are getting a raise for having done nothing more than own the company already. And it's a beautiful, beautiful thing. So here's an example. And if most people here maybe have Apple, I have Apple in my portfolio. It's actually my biggest holding. If we actually go take a look here, let's clean that up there. Apple is my biggest holding, just so we can see here. So I got about $4,254 in value in this company. Got about 33.3 shares of it, because M1 Finance lets you do fractional shares, by the way, which is why I absolutely love them. So right over here, it says Apple raises dividend by 7% to 22 cents per share. So what that really means is before this date, right here, my expectation for the dividend that I was going to get from the 33 shares that I've owned was right over here. It was 20.5 cents. So 20.5 cents is what I was expecting, but they raised it by 7%, which is jumping it up to 22 cents. Now, that doesn't seem like a lot of money, and it's really not a lot, but what does happen is that 7%, if every year they're increasing 7, 8, 9, 10%, your money is going to be worth more and more every single year. Because keep in mind, if a company is paying out, let's say 4%, but then their growth every year is even lower than this yield right here. Let's say their growth is like 1% a year or even 2%. That's barely keeping up with inflation if you really think about it. Inflation is like what, 2%, 2.5%? So 7% is well beyond inflation, and it's also better than most people's raises at work, right? Most people get like a 3% raise, maybe 4%. This is 7% raise. So again, yeah, with the amount of shares we have, which is 33 here, this is not, the make all be all kind of thing. But I want to show you something that's really, really important with Apple. So let's go back into their page here, go back to their dividends. And if you're curious, by the way, this is seekingalpha.com. This is what I love to use to kind of get all my information. So there's this thing called yield on cost. And we talk about this sometimes here on the channel where, when you buy a stock, whatever you pay for the share and whatnot, that's the yield that you're going to get for the dividend that they're expected to pay out for that annual time. And so right now, if you buy into Apple, give or take, it is 0.71% like we talked about earlier. Pretty abysmal if you're needing the money today, right? You have to put in a lot of money to even get close to, $100 or $1,000 or whatever amount of money you need, quote unquote, every month or every quarter that you're expecting to make this, because Apple pays out quarterly, in case you didn't know, not monthly. But they do that 7% raise, right? But let's say they do that 7% raise annually. Every year. We can actually see what their average is really quick. Sorry, let me jump to see what their average is. So Apple, on average, actually raises in the last 5 years, raises their dividend by 9.41%. So this last one that they just raised is lower than their average, but average is 9.4%. Really good to know. Just because when you were looking at this chart, right over here, the chart works backwards. So this is currently today, and this right here, as an example, is 5 years ago. So again, 0.71, and this is why it's so important to be able to live off of dividends for the long term. If you need them today, this is not for you, obviously, like I said. But if you're 15, 20, 30 years out, this is really cool. Look at this. So in 5 years, so if you invested 5 years ago, you would be earning on the money you invested at that time 3.74% yield on your money. Now, this is a couple things I got to mention too. One is that at that time period, back in May 19th of 2016, the yield was probably pretty low too. It was probably 1, maybe 2% at the best, but it was a very low yield. It wasn't 4%. It wasn't 3.74% at all. But what happened was, if you had your money invested, let's say you didn't buy anything more throughout that time, then that yield kept going up. So over the last 5 years, you went from, let's say, like a 1% yield all the way to a 3.74% yield. And now your money that you're making is exponentially more that you've earned every single quarter because of those increases. Now, here's a really cool thing too. Apple's also kind of a growth stock still, so you also got all the appreciation on the stock's value on top of actually just the dividend that they're paying out. And I want to show you one other cool thing too. Let's go to 10 years. So now this is 10 years over here on this side right over here, right? So you can see this. So 10 years ago, if you bought into Apple stock, your yield now would be 7.3%. That's a really good dividend yield, right? Especially if you consider that you don't need the money today, but you need it later. Because one thing people don't tell you when it comes to dividend investing is that you are going to have to pay taxes on those dividends you're earning today. So if you're earning 4% on your money today because you want to be a dividend investor for the long term for 15, 20 years out, you got to be paying on those dividends today. So if you're earning 0.71% today because you buy Apple at this point, your yield or your costs for paying those dividends, the taxes on that stuff is going to be way lower because 0.71 is going to be a very low yield. But if in 15 years, you're getting 10 years, let's just say, you're getting paid out 7%, well, now you might need that money or want to use that money. And so getting taxed on that is not as big of a deal, but it's a much, much, much better yield than when you first got the stock, plus all the growth that can happen and everything else in between that as well. Now, I'll show you one really, really popular stock with dividend investors is a company called Realty Income. So they actually pay out monthly on their dividends. So this is a kind of a cool way for somebody who is at that point of retirement that they actually might need this money now, or maybe not even retirement. Maybe they just want to live off the dividends because they have a lot of money to be able to invest all at once. Now, if we look at their current stuff, so their current yield is 4.29%. There's that 4% golden, rule that a lot of people talk about. But look at their dividend growth over the last 5 years. It's only 3.93%. Better than inflation for sure, but not anywhere close to where Apple is as far as growth. So if we go over here to that same page that we looked at with Apple, let's kind of go down here. So in the last 5 years, if you buy today is at 4.29%. Buying 5 years ago, you would be almost just a tiny bit higher than where the yield is today at 4.78%. So what does that mean, right? So if you're getting 4% back then and you're getting 4% now, you're not really changing up how much you're getting paid out. Yes, you're getting that, increase every single year. Well, actually, they do it a couple times a year, but it's not making it more valuable for you with your money long term. So if you need the money today, Realty Income is a great way to potentially put money down. Obviously, not financial advice, but you could do that and earn that 4% on your money now. But if you're somebody who, like myself, doesn't need the money for another 15 years, or my goal is 15 years, getting that 4% now is costly because I got to pay the taxes on it. Sure, I can reinvest the money, which is always a good thing because reinvesting your dividends helps compound so much better. But you got to pay those taxes, right? You got to pay those taxes today, and the stock doesn't really change that dramatically over the course of that same time frame. As far as like what you're actually getting paid out, not paid out, what you're actually getting as growth for your stock is not going to be the same as you would with like an Apple stock, right? Because if we actually go to the summer here, so let's go to 5 years. So the last 5 years, you could see here. So the stock price 5 years ago was about $59.05. Today it's $64, $65. So your stock value went up $10, give or take, in 10 years. Or sorry, 5 years. It's not that great, right? Like, obviously the dividends will help that change up. And it's a little bit more secure with companies like Realty Income when they've been doing it for so long. If we go to their news, let's see what their dividends here. So the last time they increased their dividend, with Realty Income, as an example, they actually increase it multiple times a year. So sometimes they increase it as low as 0.2%, not even 2%, 0.2% on this one, which is really, really low, obviously. Let's see here. Where was their other dividend increase? This one also was a 0.2%. So you can see here very low increases in comparison to something like an Apple, where they were increasing substantially higher on their dividend yields. So just kind of when we look at these and see, look, another 0.2%. So not even a full percent. But when you add up in a given year doing 0.2%, it will get you closer to like about a 2 or 3. I think average over the last like 3 years, Realty Income has been increasing their dividend by about 2.5%. So lower than what their 5-year average was, just kind of like how Apple was doing as well. I don't own any Realty Income in this portfolio anymore. I did at one point actually have them. I'll show you here, just so you can see. But that was something that, like I mentioned earlier, you can start one way with investing and then it can completely change. So I sold out back in March of 2020. I had about $778. I used that money to buy into different companies that hopefully over time will either increase their dividend at a better rate and or start paying out a dividend, which is another thing I want to mention. So I actually have a couple of companies here. So like if I go on my growth stock here, or growth pie, I got companies like Tesla, Amazon, Google, and Facebook, none of which actually pay out a dividend today. And for a lot of dividend investors or dividend growth investors, they're like, why would you invest in something like that? They're not paying out a dividend. What's the point of that? But obviously, one, there's risk with any kind of investing, whether it's dividends or growth stocks, all that stuff. So for me, the way I'm saying it, one, I like these companies. I want to be invested in them regardless if they're paying a dividend or not. I feel like the value will definitely grow faster. If by the time I want to start start taking out dividends for myself, if these companies are not paying out a dividend, I could always sell them and then switch over to something like Realty Income and get that 4% at that exact time when I do want the dividends and living off of them. Or better yet, maybe they start paying out a dividend within the next 15 years. And that could be a possibility. Not saying that it will happen for sure or anything like that, but I want to show you going back to the example of Apple. So let's go to Apple really quick. So with Apple, they actually, they had like dividends on and off at some point, but if you actually look at their dividends, let's see, I think it was starting in 2012 is when they actually started paying out a dividend. So back in 2011, if you were investing, you were not getting paid out a dividend for them. So here's something really cool. So if we go to the max here on the yield on cost. So if we go to 2011, right over here. So back in 2011, investing into the company that wasn't paying out a dividend, but you were still buying into them, you theoretically were going to have a yield at this point to this day and age at 6.26% yield. Way, way beyond the 4% golden rule that a lot of dividend investors go off of, which is why living off of dividends is a great way to go, but doing it faster can mean that you're focusing on the companies that maybe don't always pay out the dividends right away. Check this out. Let's go back even further. So in like 2008 and 9, when like everything was kind of down for a long time, can you just imagine you buying into Apple at a very low price point? You're going to have these amazing years of growth over that time, but they weren't paying out a dividend at that time, right? 2009, no dividend. But let's say you put in $10,000 in 2009, amazing growth. Your yield on cost would be 24%. That is a lot of money that you'll be getting every single quarter in dividends, because you were buying in at a time that, one, was obviously at a low point in 2009. The stock market was, bottoming out at that point. So, for a lot of people, when the market goes down, they get fearful, they sell out. That's why I like buying in during the red. I mentioned it earlier. When the stock market is red, I buy in more. But you can see right here, 24%. Just imagine getting 24% every quarter for having put in whatever amount of money you could have at that time. 10,000, 15,000, or you've built up to that point, right? Because maybe you couldn't do it right away, but you were buying in since 2005. Look at that, 66%. That's almost too crazy. Obviously, it goes down as the market goes up, because when the stock price goes up, the yield goes down. It's inverse there. So when the stock price goes down, the yield goes up. So during a downturn in the market, the yield can actually go up a decent amount higher. So buying at that point, your yield on cost will be, of course, better. But as the years go on, if you hold on to that company like I am with Apple, we talked about here, if I go back in here, I have 33 shares of this company. I didn't buy them all at once. If I bought it, I don't know, because right now I'm up about $435. Obviously, with the market being down right now, up and down, I think in the last month I'm down a decent amount. But if I had taken all that, I didn't have $4,000 to just dump in this company. But if I did that when I first bought them, which was in December of 2019, if I had just thrown all that money in there, the yield would be even better than it is today, which is a really cool thing. But the yield on cost can be different for everybody. So you buying in today, your yield would be the 0.71%. And my yield, if I go back here, well, this is a little outdated, but my yield, I believe, yield on cost is 0.78%. So this is my yield on cost. This is a tracker I use right over here. So you can see here, yield on cost. So my yield is actually better than somebody who's buying in today, even though it doesn't seem like a lot, but still, those increases, if I stopped investing in today, my yield on cost will go up. I just won't have as many shares in the future if I don't keep buying in today. But you can see here, this is actually a little outdated. I have to update this because I'm only at 30 shares on this page, where in my actual portfolio, I have 33.36 shares of Apple on there as well, total. But I think the really important thing is making sure that you are focusing in and understanding how dividends actually work, and that living off of dividends is really great. But if you don't need them today, I would consider looking at the opportunities of companies that have great growth in dividends for the long term. Like Home Depot is one of my favorites. I talk about them a lot here on the channel too. I really like their company. I love their fundamentals. I love how they kind of are looking in the future. And also their dividend growth has been really, really nice. But for somebody who needs dividends today, looking at companies that are paying, 3.5%, 4% makes more sense for you, because you need that money at this given time. So obviously it's always up to you and what you think and what's most important to you, and always do that, because I think that's really important as well. And what I actually want you to do next is click on this video here, so you can kind of keep watching and learning more about investing in the market, as well as dividends and everything in between. My name is Dennis, and I'll see you in that next video.